Okay, marginal tax brackets are the lines at which the rate increases as you make more money. It's called a progressive tax system. So your first little chunk of income is taxed at 10%, the next section is taxed at 12, and then 22, 24, 32, 35, and 37. A common mistake here is people think that as soon as they cross, for example, from 12 to 22, that all of their income is retroactively taxed at 22 down to their first dollar. That's not how it works. The first chunk will always be 10%, and then 12, and then 22, and so on. So these rates, we've had them for a while, ever since the Tax Cuts and Jobs Act. If that act sunsets, like it is scheduled to in the end of 2025, in 2026, we will receive new rates. So the 12% goes to 15, 22 goes to 25, 24 to 28, 32 to 33, and 37 to 39.6. So most brackets experience a change of approximately 3%. So that would be an additional tax that we would all pay on the same amount of income because the rates are higher. Okay, let's talk about long-term capital gains. The rates are still 0, 15%, 18.8%, and then 23.8%. Now, when you look online, you're going to see 0, 15, and 20. The reason I say 0, 15, 18.8, and 23.8 is because after the Affordable Care Act, a 3.8% net investment income tax was introduced for people who have over $200,000 of income if you are a single person, or $250,000 of income as a married individual. So what's happening here is you have enough income that they're going to charge you this extra 3.8% on any investment income, capital gains, interest, dividends. This is all investment income. So be aware that you could potentially get capital gains out at a 0% tax bracket if your income is low, 15% if it's moderate, and then as it gets higher, it will go to 18.8 and 23.8. These are the various brackets you might experience for long-term capital gains. It's important to understand standard versus itemized deductions, both when you're filing your taxes and when you're thinking strategically about what to do through the year to minimize your taxes. Itemized deductions is when you add up all the things that the government has said, these are things we will let you use to reduce your income. And you can add all these up and we'll let you use all of them. Or you can just take this standard number over here and you don't have to worry about tallying up all your itemized deductions. Most people should do it anyway and figure out which is greater, the standard or the itemized deduction, and take the greater deduction because that will reduce your income by more. The standard deduction has increased a little bit. For a single person, it's gone from $14,600 to $15,000. For a married couple, it increased from $29,200 to $30,000. Head of household, $21,900 up to $22,500. So each of these standard deductions has gone up a little bit, which means that it will reduce your taxable income by a little bit. Nothing huge here. The standard deduction will decrease if the Tax Cuts and Jobs Act sunsets. So the standard deduction will be cut roughly in half. We won't go into all the numbers, but understand that the standard deduction decreases in half. The tax rates go up by about 3%. Exemptions come back, which is a good thing. It's kind of like a standard deduction. So a few changes, those are the three key ones that most people will need to be aware of. For those of you over 65, you have an additional deduction available to you, and that's also gone up a little bit. For single filers, it used to be $1,950, $1,950. It's gone up to $2,000. And then for those who are a couple and both of you are over 65, it now is $1,600 each or $3,200 as a couple. So be aware you have that extra standard deduction if you are over the ages 65. Okay, we talked about exemptions so far. Exemptions would be approximately $5,300 per person. So this is basically saying add up all the people in your household that file or are included on your tax return and then multiply that by approximately $5,300. Those would be the exemptions you'd be able to take. This is not a 2025 thing or a 24 thing. This is, again, if the Tax Cuts and Jobs Act expires or sunsets, this is what it would be like in 2026. We're always thinking ahead. We want you to be planning with the future in mind. The best tax strategy is usually when you compare multiple years against each other and take advantage of the difference in those rates.